In this video, we're going to be looking at the corporate governance. This is extracted from November 2024 Cost Accounting Paper 1. Let's see what we have in this question. It says you are provided with an extract of the independent external audit report of Valiant Ltd presented to the shareholders at the annual general meeting. So what you know here is that the company name is Valiant Ltd, and then they have an AGM, and in the AGM, they presented the independent external audit report. So the report from the external auditors. What are we required to do? We are required in your answer to not repeat your response in different questions. So if you already provided the response, do not repeat what you've already provided in the different question. And the reason the examiner is saying that is because you have 5 questions. So in this 5 question, it might happen that you find yourself in 4.5 repeating what you've already answered in 4.1. So you are required to ensure that you do not repeat what you have already answered or what you have already provided in your solution. Now let us look at the question that we have. 4.1 says, explain the role of the independent external auditor and provide 1 point. So you basically have to state what is the role of the independent external auditor. Just to summarize what the independent external auditor, so it is the auditor that is coming from outside the firm. So that those auditors are not employed by the firm. So they just come to audit the financial statements of the company. What are they doing is to see that the financial statement fully present what have happened during the year. So they want to assess the fair presentation of all the items in the financial statement. That is, they are in line with the accounting requirements or any legality surrounding that company. Most important thing is that the audit report that they were provided, it assumed to be unbiased. And why is it assumed to be unbiased? It's because they are not conflicted or they do not have interest in the company, with the exception of just auditing the company. So that's like the overview of what the independent external auditors are. Then 4.2 says choose the correct word from those in bracket. Write the answer in the answer book and explain your choice. So they're saying Variant Ltd receive A or N qualified, unqualified disclaimer of opinion or report. Just before we go to look at the solution, I'm just going to explain to you what are these opinion means. If we talk about qualified audit opinion, it then says there are some items in your financial statement that are not in line with accounting standard, or maybe you have not followed the laws and regulation of the company in those line items. With the exception of those line item mentioned, most of the things that you've presented do fairly present the operation of the company. So this one is mainly says you have fairly presented your financial statement in most of the item. However, based on the auditor's opinion, there were items that were material and those items were not fairly presented. And then you have unqualified opinion. Unqualified opinion, it's a good opinion, and it simply means that the financial statement fairly present in all material matter. Meaning to say there are no material items that were identified to not be in line with the regulations, acts, or accounting standard. So meaning to say most of your things, they were fully presented, or all of your things were fully presented, and there was nothing material that needed to be brought forward to the attention of the users of the financial statements, which are your shareholders and other stakeholders. And then disclaimer opinion. So what happens now with the disclaimer opinion? Disclaimer opinion means that the auditors did not obtain some of the information that they wanted to receive from you in order to provide an opinion. So some of the information were not obtained. It will mean that they requested maybe an asset register and you did not provide an asset register as the company to the independent external auditor in order for them to provide an opinion on most of the items that are sitting in the financial statements. So that basically summarizes this opinion for you to understand what each opinion mean to you. Then 4.3, ask what kind of audit evidence does the independent external auditors examine to verify the fixed asset of the company? Provide 2 points. So you need to provide 2 points in terms of if the auditor were to come and want to verify the fixed asset register of the company, what information they can use. Just to give you an example, fixed asset, are your assets can be your property, your cars, or any other form of tangible asset that the company has in the business. So now the auditor is coming to you and asking what they can use in order to confirm that. It could be your supporting documentation that you have when you acquired that fixed asset register. It could be your fixed asset register, or it could be the support of the verification that was performed during the year. Could be done by internal auditors or anyone that is considered to be a little bit independent when looked at the firm. So you need to provide 2 points. And then 4.4, what are the implications of this audit report for the following directors and shareholders? 1 point in each case. What are the implications of the audit report for the following, the directors and the shareholders? So we know directors. What are directors? Directors are the head of the company that are trusted by the shareholders to manage the company. So the company has to be managed well by those directors because shareholders are not there every day to ensure that the company is managed and well run. So therefore, they decided that they have someone they trust or people they trust and they call them the directors of the company. They provide a direction in terms of how the company is operated. And when you look at the shareholders are basically the owners of the company. They have shares in the company. However, they cannot run that company. Meaning to say, if directors manage the companies very well, the shareholders benefit. However, if they aren't managing the company very well, then the shareholders do not benefit, or they're running a risk of losing the entire investment that they have put in that company. And then you need to state 1 point in each case. And the last question is 4.5 says state 3 possible consequences for the independent external auditors if he was influenced by the directors of the company to deliberately provide the shareholders with an incorrect audit report. So, as I've stated above, there's a difference between the directors and the shareholders. Directors are owners of the company, while the directors are people trusted by the shareholders to run the company or to run the company in which they have shares or they have investment in. Now, when you're looking at 4.5, it required you to understand directors and shareholders. So now what they're saying is that give 3 possible consequences if it happens that the independent auditor has not provided the correct opinion because they were influenced by directors. So it means that the auditors, instead of providing qualified or disclaimer opinion, they provided unqualified audit opinion to the shareholders because shareholders are the main users of the opinion. So now if it happens that the shareholders received the wrong opinion, what will happen to the external auditor? 2 things you have to look at. You have to first look at their employer and also look at them, right? So the employer will have to take them through disciplinary action if they provide a wrong opinion. They have to be, sometimes they can even be fired if the opinion provided was too severe that they cannot ever trust the external auditor. And then when looking at the professional body, it's IRBA. So IRBA governs or manage how the external auditors are working out there in the public. So IRBA might say, we need to take you through the disciplinary action. Subsequently to that, you can therefore end up finding yourself being taken out of the role, or what else could potentially happen? You can lose your license to work as an independent external auditor. Then let's look at the information that we have. In terms of the information that we have, this is an extract. So it's an extract of the independent external audit report for Valiant Ltd. This is the part of the audit report that will give us an opinion in terms of the kind of opinion the company has obtained. If you look at the opinion that says, in our opinion, the financial statement fully present in all material respects the financial position of the company as at 29 February 2024. Basis for audit opinion, and the audit evidence obtained is sufficient and appropriate to provide basis of the opinion. So this takes us to the end of this question, which is question number 4. And what is important for you when you're looking at this opinion? It's the fact that this is an unqualified opinion. Why is it an unqualified audit opinion? As I have explained earlier on, if there are no issues or no material issues that have been noted during the audit opinion that will be obtained by the auditor's client will be unqualified audit opinion. It's unqualified on the basis of the fact that there's nothing that came to their attention and that is material misstated, or is not done according to the laws, or it is not done according to the standards or the IFRS standards. So they said they've obtained sufficient and appropriate audit opinion. So meaning to say they cannot issue a disclaimer because all the information they asked from Valiant Ltd they have obtained, and they were happy about the information that they have obtained. So that confirms this is indeed an unqualified audit opinion. So now we are done with question 4 in terms of reading what we have in the question paper. We are now going to move and look at what do we have in the marking guidelines in terms of answering what were the questions that were sitting in the question paper. I'm going to move you guys to what we have on the marking guidelines, and we'll go to it together by first reading the required, and then once we're done reading the required, we'll then move to the answer that have been provided in the marking guidelines. We are now on the marking guidelines, and it is question 4. Let us look again what 4.1 wanted from us. It says explain the role of the independent external auditor. So they said provide 1 point. You do not have to provide all this point. You just need to provide 1 point as requested. You have all this point for the benefit of the marker to select one in those, or one that is in line with what we have. So they said the first part is to provide an unbiased audit report on the financial statement of the company. So why is it unbiased? Because the external auditors is independent of the company. So everything they were not part of preparing. So it gives them a clear view, an unbiased view in terms of whatever they are provided, it is correct or not correct. So they are then able to conclude on whether the financial statement fairly present or all the numbers have been prepared in line with the regulations and the standards applicable to the company. So it will be unbiased because that person has no interest in the company, with the exception of just providing the opinion after they have done the thorough audit on the company's financial records. Number 2, is for them to present an opinion on the fair presentation of the financial statement. So when you're looking at fair presentation, is that everything that is there, it actually what happened. So everything fairly present the operation of the company. What does that mean? The company didn't say they made billion of revenue. However, the truth is they made 500,000, or they made a million, or they made 500 million. So they're showing a fair presentation of what actually happened during the year ended that is being audited by them. And when you look at what we have there, is to protect the interest of the shareholders as well as the public. So why auditors are even there? They are there to ensure that they protect the interest of the stakeholders. So who are stakeholders? It could be your SARS, your shareholders, your employees, and everyone that has an interest in the company, which also included the general public. So if the auditors come to the company and they audit the books of the company and they say everything it's fine or it fully present, that is used by a number of people in order to see whether can I still be employed by this company, or this company is about to close. I need to look for other employer. The shareholders are asking themselves, based on the information that we received from the auditors, is this company doing so well that I can still keep my investment, or do I need to sell my shares in this company and alternatively buy to the competitors, or even stop buying shares? So if this independent external auditors, they are providing the audit opinion that is not fair or doesn't fairly present, it's put so many people in a position that they shouldn't be at, because now they're using or they're concluding on their judgment based on the information that is not true, or rather not correct. So that takes us to the last part of the 4.1, where we discuss things that, or the role of the independent external auditor. Then we're going to move to 4.2. Choose the correct word from those in bracket. Write the answer and explain your choice. So you're going to have to write the answer. Once you have written your answer, you need to explain your choice. So what mistake you would have done when you're looking at this 4.2? You would have potentially wrote the answer and forgot to explain. And by forgetting to explain, you will lose 1 mark because you would have not explained. So when explaining, you just need to give 1 point, because it's 1 point for stating the opinion and 1 point for explanation. So you see here we have 2 points. However, you don't have to write 2 points in your exam, because you have 2 marks, meaning to say one for audit report and then one for explanation. So let us look at the audit report opinion. It is an unqualified audit report. As I've stated when I was going through the scenario with you, or when we were going through the question, because they have stated that after auditing the financial statements, they obtained all the evidence, and in the audit evidence that they requested, there was nothing that was material misstated. Everything was material correct. For that reason, they received unqualified audit opinion. In terms of explanation, there were no errors, problems, or irregularities that were discovered. Opinion indicates that the financial statement fully present the financial situation of the company. So that is your reason of saying they have received unqualified audit opinion. So you're summarizing what is already in the audit opinion that was presented to us. We're then going to move to 4.3. 4.3 asks, what kind of audit evidence does the independent external auditors examine to verify the fixed asset of the company? You need to provide 2 points. So they said any suitable relevant response will earn marks. All right. So now we're going to have to respond in terms of the evidence. Right. So we're going to look at the number of evidence that we have here. And then once you have evidence, then you get 2 marks for each evidence. You need to confirm the physical existence of the item listed on the fixed asset register. So that means you go and do the physical verification. If they're saying that the asset is sitting at Ikobo, you go to Ikobo, you find those assets, you correspond them with the asset register. Then once you're happy with that, then they do physically exist. Check the calculation of depreciations are correct. Check the correct depreciation rate are used. So the second part is that you need to confirm the value at your end. And in order for you to confirm the value at your end, the value is influenced by accumulated depreciation, which would have been audited in the prior year, and the depreciation for the current year. So what you need to do, you need to confirm that the depreciation calculated is correct, or rather the rate used is correct. To include above this, also the method is correct. What we mean by method is that are they using the straight line or diminishing balance method? So that is very important for you to also list in terms of verifying the balance or the fixed asset of the company. Check the invoice and receipts against the cost price written on the fixed asset register if they are the same. So you're basically now looking at the invoice and receipt. So whatever that is stated in the invoice for the purchase of the asset, it has to correspond with what was listed in the fixed asset register. The other part, you'll be checking if the correct procedure followed in the procurement of new fixed asset register. Check if correct procedure were followed in disposing the fixed asset register. So this one is basically the compliance part where the company, whenever they're buying or disposing, they needed to follow the procedure or the accounting policy of the company when it comes to doing that procedure. The last part, you check the registration certificate or title deed in case of the building to confirm ownership. It might happen that unfortunately in your fixed asset register, you have asset that does not belong to the company. It is for that reason that you have to obtain registration certificates as well as title deed of the company just to confirm or to obtain evidence that those are indeed the, the asset of the company. And then we have response for one mark. It will be your fixed asset register, your logbook, your source document. So if you stated this in your response here, even if it's not in line with what you have here, you will get a mark for it. Then we're done with 4.3. Let us move and see what is in 4.4. 4.4 was saying, what are the implications of the audit report for the following? We're asked to look at the director as well as shareholder, and we need to provide 1 point for each. You see, when you're looking at the solution or the marking guidelines, you'll have more than one. But when you're answering, you need to answer based on the question. If they say one, bring one. The reason you find more than one here is because this is a marking guideline. It guides the marker when they are marking your script in terms of whether they should provide you the points or not. Right. So this is more a guideline for the marker. And then state 1 point. So the first part it says directors. Any suitable relevant response will add a mark. Will be reappointed by the shareholders. Improves their credentials or reputation. So now we're looking at the implication of the audit report. So what are we saying? Here we're saying if they're happy about the performance of the directors, the shareholder will reappoint the director. But if they're not, then unfortunately the contracts will have to be terminated. Also, if your company or the company that you're working with is doing well, your credentials and reputation will improve. Any company in future will poach you or will want to work with you. And then for shareholders, they will be satisfied that their investment is safe if they get unqualified audit reports, like in this case, because the audit opinion is unqualified. So now it gives them the surety that their investment is safe. Why is the investment safe? Because the directors are acting in the best interest of the shareholder and other stakeholders. It will encourage further investment in the company. If you have investment in the company that you feel like is doing so well, for example, you're investing in MTN, and you feel like your investment is doing so well, each and every year your investment is growing. What do you do as a shareholder? You put more money on that investment. Then that takes us to the end of 4.4. Let us see what 4.5 has for us. And 4.5 is our last question. It says, state 3 possible consequences for the independent external auditors if he was to be influenced by the directors of the company to deliberately provide shareholders with incorrect audit opinion or audit report. So when will the director be influenced to do that? Is that when the director is not doing so well in the company, or the company is not doing so well, but the director still want to keep his or her position, what he might do instead of the auditors providing qualified opinion or disclaimer or adverse opinion, they will sit with the auditors and said, can you please provide the shareholders and other stakeholders an unqualified audit opinion, which is the best opinion. And the reason they will be doing that is because they want to keep their jobs and they want to keep their reputation looking so well in the public when actually they are not doing so well. And then now, considering that you see what the directors will be doing is not right, you need to look at the three possible consequences as a result of misleading the shareholders as well as the public. So, as I've stated when we're going through the scenario or when we're going through the question papers, the number of things that you have or the number of parts you need to look at. There will be IRBA. IRBA is the governing body of the auditors. There will be the employer of the auditor, and there will be the auditor, him or herself. So, three parties you have to consider the consequences that would happen to them. Now, let's just look at what we have. Possible consequences for auditors as an employee, right? What will happen might be deregistered or struck off the role of EBA, which is an accounting body for auditors, will lose professional license as well as the certificate. Disciplinary hearing might take place or even suspended or fired. Can be suspended or fired by the current employer. Might be fined or even go to prison. What else might happen or done by the shareholders? Shareholders might sue them because the shareholders will be convinced that the company is doing so well. Then they might even put more money instead of selling their shares. And why the shareholders will do that? Because they're the owners of the company and they will be so mad on the negligence of the auditor when providing that opinion. And obviously, the name or the reputation of the director will be in marred, or of that auditor will be in marred. Possible consequences in terms of the company that has employed this auditor, they might lose client or remove as the auditors of other clients. Loss of employment to staff as members of clients' base will decrease. Our current contracts will be challenged in future and bad image of the company. So just one external auditors that have decided to be so great and provide a wrong audit opinion might put the company in such a very bad position, the company that he or she is employed by. And also the shareholders are going to be in a very bad situation by them continuing to keep the shares when they should be selling them, or by them adding more of their money in the investment of the company when actually they shouldn't. That takes us to the end of this governance question. Thank you so much for listening to me up until this point. Can you please subscribe to my YouTube channel? It's Economics 199 if you are listening from my TikTok. If you're listening from YouTube, please follow me on TikTok. It's also Economics 199. Thank you so much and all the best for your accounting grade 12 going forward. Bye.